Hello, everyone, and welcome to Thursday Talks with Chuk. Each week, we cover pressing topics that matter to you and your business. I'm Arianna Gonzalez from Chuk, attorneys and CPAs, tuning in from our San Diego office. Please join me in welcoming CPAs Shruti, Shah, and Heena Patel from our Santa Clara office. Hi there, Shruti and Heena, and welcome. For today's topic, we will be talking about local level taxes for businesses. Just a quick disclaimer before we get started, this conversation is for informational purposes only. It does not create an accountant-client relationship, so if you do have questions, please comment them below or email us anytime at info@chug.com. So let's get right into it, ladies. Why should businesses care about local taxes?
So basically, businesses often usually focus on the federal and the state income taxes, but local taxes also do play an important role and they materially impact the total tax burden for businesses. So while federal and state taxes have the most attention, businesses that operate within the US must also consider having the local level taxes imposed by cities and counties as well. Many a times what happens that the cities impose taxes and it can trigger or increase the effective tax rate of businesses in high tax jurisdictions. It can also trigger compliance obligations such as registration, filing requirements, like quarterly filings, annual filings with those cities, and expose those businesses to penalties and audits in case of non-compliance. So it's always best to keep these local taxes and city obligations in check while you're making a compliance checklist.
Absolutely great information there. Can you tell us about the main types of local taxes that are imposed on businesses?
So businesses may encounter a variety of local taxes, ranging from income-based taxes, that's typically based on the net income, like it's similar to the federal and the state income tax being imposed. Apart from income-based taxes, local at the local level, you also face gross receipts tax, which where it doesn't matter if you're actually making profits or losses, but you're actually taxed on the gross revenue that you earn in that particular locality. Apart from these two, which are the primary ones, like income and gross receipts, there are other taxes as well, like the payroll taxes, the sales taxes, and other miscellaneous taxes that typically depend on having a rent or a utility tax or a commercial rent tax there. Also, there are also certain taxes that are very industry specific or location specific. So there are these other taxes as well at the local level.
Wow, quite a few different things to keep in mind there. Can
Yeah.
you tell us what triggers local tax nexus and what we know about that?
Yeah. So nexus basically depends on multiple factors when you are evaluating the state nexus limits. But when it comes to the city taxes, physical presence is one prime factor that determines the nexus for these taxes. But apart from physical presence, there are other factors as well that might trigger having a nexus in these areas. First and foremost, being having a remote employee based out of that locality. Another thing that can trigger a nexus would be contractors that are performing services locally, or having an inventory or a warehouse or a sales activity that's being conducted from that particular locality. So, yeah, multiple things that trigger these nexuses, and usually there are certain thresholds that you need to take a look at. These thresholds are pretty less, as low as $50,000. So once you cross those thresholds, you're subject to nexus and then have those compliance obligations in those localities.
Oh, wow, that's good to know. So if you are watching this and have questions about the Nexus tax, feel free to reach out to us. We'd love to help you and guide you through that. So which
Yeah.
city levy taxes based on corporate income?
So couple of cities, like there are multiple cities that have those income-based nexus, income-based taxes. So first, the most important city, like that has the highest taxes, is the city of New York. It levies around 8.85% of business corporation tax that's based on net income. Uh, Followed by New York City comes the city like Washington DC. That too again has a higher tax rate, and that's around 8.25%. Apart from these two cities, the next city that has a higher tax rate is Philadelphia. So Philadelphia in Pennsylvania, it levies around 6% taxes on the net income. But apart from this, the city of Philadelphia also has gross receipts tax. So multiple things to consider when it comes to New York City, Philadelphia. But right now, since you've questioned me on income-based taxes, I'd say like apart from New York City, Philadelphia, Washington D.C., some major other cities would be cities in the state of Ohio, like Cleveland, Cincinnati. Uh, the tax rate typically ranges there from 2 to 2.5 percentile, and cities in the state of Oregon, like Portland or Multnomah County. Uh, and Detroit in Michigan, they too have this income-based taxes. So at the end of the day, to summarize, like there are multiple cities involved, each have a different tax rate and a tax structure of determining how to levy and how to carry out the obligations. And it also varies depending upon your business structure and the scenario you are in. So it's always best to evaluate multiple things simultaneously before you determine that you have a tax obligation there.
Yeah, it definitely seems important to look at that before you think about where to place your business. So there's
Yeah.
a wide range of percentages there. Are there
Yeah.
any key thresholds or minimums that we should know about?
Yes, for sure. So, like we mentioned, for like that, New York City has the highest tax rate of around 8.85%. So that's purely based on your income, on your net income in the city. But along with that, the city of New York also has other thresholds, like the net worth tax, that's around 0.15 percentile, and the fixed minimum threshold, like the minimum taxes are based on your gross receipts, and it typically ranges from $25 to 200,000 depending on your gross receipts in the city. So, what New York City basically does is it evaluate all of the three criteria: the income base, the net worth, and the minimum thresholds, and it will just evaluate all of three together and take the one that has the highest liability and charge tax on that particular threshold. So that's how New York City computes taxes. Apart from New York City, there are other cities as well. Portland has a threshold limit of around 50,000. If your gross receipts exceed 50K, you would be subject to tax in the city of Portland. Uh, and failure to meet this may subject you to penalties. There are other cities as well that have these thresholds, and it's best to evaluate city by city.
Really important information there. I want to talk about payroll taxes a little bit. Which
Sure.
cities impose taxes based on employee payroll? Do we have information on that?
Yes, I do. So, in terms of payroll taxes, so often our understanding is payroll taxes are subject to be withheld from an employee's W-2. But that's not the scenario when it comes to the local level. In terms of low payroll taxes, even though it's termed as payroll, even though it's we call it payroll expense tax, every city has a different terminology for it, and the way it's being calculated is also different. So how what payroll expense is basically, it's basically subject to tax. It's basically a tax that's imposed on the employer if they cross a specific threshold of payroll in a particular city. So for instance, I can give you an example. The city of Seattle in Washington, the payroll expense tax is called as jumpstart tax there. The rate of tax is typically ranging from zero point 0.7 to 2.4 percentile. But how it's computed in Seattle is if your payroll in the city of Seattle exceeds $7 million, only in that scenario you would be subject to the payroll expense tax. And then after evaluating your eligibility for the tax, you would go to the next step in terms of calculations. So when it comes to calculations, you would basically calculate the payroll for only those employees where the wages exceed 150K. So yeah, that's a lot of information to process for the city of Seattle, but I think it works similar for other cities as well. So another example that I'd like to give you is for the city of New York. New York again, it's called as MTA payroll mobility tax. MTA implying the top five cities in this top five localities in the city of New York, that's Manhattan, Brooklyn, Bronx, and other cities like areas in the city of New York. The tax rate there is around in the range of 0.89%, I think. And it would only apply in a scenario when the payroll crosses $10 million there. So that's another city that has this payroll criteria, uh, a threshold criteria. And then, since we've already discussed the city of Portland in the past, the payroll based tax in that particular city is called as clean energy surcharge tax. It basically would arrive only in a scenario when your global payroll, as in your total payroll, not in the city of Portland but across the globe. So wherever you have a payroll, you just total it up, and if it crosses $1 billion, and there is an and condition, and if your sales in the city of Portland exceed 500K, that's when the clean energy surcharge tax would kick in, and that's when you would pay taxes in the city of Portland in terms of payroll based. So yeah, that's how it is for payroll taxes.
Wow, very interesting information there. It's really cool to see how different, each city and state is. So,
Yeah.
do small businesses get exempted from this? What happens to them?
Yeah, they do. So, like I mentioned, that there are multiple thresholds, like in the city, in the city of Seattle, New York, Portland. Like I mentioned, all the thresholds. So those are minimum thresholds, and these thresholds pretty seem to be pretty high. So it would only kick in when there's a large business that's involved. So yes, in case of small businesses where they do not meet these thresholds, they'd be exempted from this payroll tax implications at the city level. So I think we should small businesses like have a safer role there.
Wow, that's good to know. So, what is a gross receipts tax and where does this apply? Can one of you give me information on this?
Gross receipts tax is basically a levy on businesses' total revenue, regardless of whether it's profitable. Unlike income tax, it does not allow deductions for operating expenses, cost of goods sold, payroll, etc. This means even loss-making businesses may owe gross receipts tax if there is revenue generating in that business. So, which are the major cities where it would apply? Some of the examples are San Francisco. Uh, it applies to gross receipts. So in 2024, it's over 2.25 million of revenue, and the rates vary by industry, ranging from 0.16% to as high as 1.008%. So, for example, professional services may face higher rates than retail services. And the tax itself is also threshold based. So the effective tax rate comes out different for each business. Um, then there is Los Angeles, and they have similar gross receipts tax, but it's called business tax. And the rates again vary from 0.1% to 6%, depending on business classification. And there are many, many classifications done by the city. So it's important to look carefully on how you are classifying the business. Apart from San Francisco and LA, there is tax in Philadelphia, as Shruti had mentioned earlier. It applies. It's called business income and receipts tax, and it includes 0.1415% of the gross receipts component, in addition to whatever they are paying for the income tax. Seattle again has something called business and occupation tax, similar to the gross receipts tax in San Francisco, and rates vary depending on business activity. Other cities would be Washington, D.C., and some of the cities in New Mexico cities. So it's different for each city, and they have their own criterias or different rates, and the classifications can also vary based on whatever the city defines it as.
So, does it matter what industry somebody is in? Are some industries taxed differently? Are they all the same?
Yes, of course. Gross receipts tax rates often vary, and they are tiered by industry to reflect upon the economic impact and profit it generates. Retailers may pay lower taxes due to their margins being thinner. Financial services, law firms, and consultants often face higher rates. For example, in San Francisco, technology firms and professional services are subject to higher gross receipts tax brackets. And then even Los Angeles businesses divides it into dozens of categories, each with its own rate. So the steering can significantly affect the tax planning and entity structuring for that matter.
Wow, that's really interesting to know. So, how do sales taxes differ at the local city level?
So apart from all the taxes that we have already discussed, sales tax can also impact the tax liabilities at city levels. Although they are often passed through, several US cities impose additional local sales tax on top of the state tax rates. So that significantly increases the total tax burden on all retail transactions. So, for example, if we take Chicago, it adds 4.75% on top of the state tax, sales tax that it is already levying. So, the total combined rate comes out to about 10.25%. Um, New York City also adds about 4.5%, and which brings to the combined rate of about 8.875%. Cities like LA, Seattle, Denver also impose their own local rates, often influenced by these specific special districts. The local additions can vary widely and impact both pricing strategies and compliance obligations for businesses operating in these multiple jurisdictions.
And what are key compliance risks with sales tax?
Sales tax, there are few things that every business should keep in mind. There is nexus creation, like having employees, inventory, or digital presence in the specific state can trigger tax obligation. There could be sourcing errors that could affect the compliance risk, like misapplying origin-based versus destination-based rules can lead to under or over collection of taxes. Sometimes even marketplace facilitators have different rules, like platforms like Amazon may collect tax, but sellers must ensure that it is getting reported properly.
And are there any lesser known local taxes that we might not know about?
There are a lot of other miscellaneous local taxes. It's hard to cover everything like in a session. But beyond sales, income, and gross receipt taxes, many cities impose lesser known local taxes that can catch businesses off guard. These include commercial rent taxes, like in New York City, utility user taxes, taxes on electricity in certain California cities, business license taxes based on employee count or revenue. There are even parking and transportation taxes in urban areas like Chicago. So while it is often overlooked, these taxes can significantly impact depending where your location is, what industry you're in. So it's very important to review all local obligations when operating or expanding in a new city. These taxes often affect site selection, lease obligation, and negotiations, and even operational costs on day-to-day basis.
Wow, quite a few different things to consider there. Thank you for covering that for us. I do have one more question for you if you're open to sharing. If you have any city-specific examples where clients either got into trouble or maybe saved on taxes. I know examples are always a great way to get the idea into people's head and remember it. So anything you guys want to share?
Yes, I recently had a SF-based client. Their revenue was about $1 million in the previous years, but suddenly their revenue was crossing the threshold of 2.25 million in 2024, and they were not aware of these filing obligations. They only found out when they got a letter from the city, and they ended up paying a note, like the high penalties and interest because they were a couple of months late in filing as well as paying the taxes. Another example, this is a very good example because we ended up saving a lot of tax for a client. So one client was going through due diligence for their merger and potential merger with a company, and they flagged a transaction for a vendor in Fairfax County, Virginia. So they had a lot of revenue generating from that county, and then they were looking at an exposure of about 200,000 in the county. Um, but they reached out to us, and we were able to contact the county, and we figured out that they charge based on cost of performance method. So even though the revenue was there, all the employees were working remotely out of California. So the cost of performance rule would say it was performed outside of the county, and then hence they did not pay any tax on it. So there could be a tricky rules about these taxes, and it's always better to reach out to professionals and get it verified before panicking or anything.
Absolutely. Wonderful insights today. Thank you so much, Heena and Shruti, for taking the time to answer all of these questions. That is all we have time for today. So this brings us to the end of our conversation. Thank you, everybody, for joining us today. To stay up to date, please subscribe and follow us on Facebook, LinkedIn, and YouTube. And if you have any questions at all, send us an email at info@chug.com. Let us know what topic you want to see next. And make sure to join us back here next week for more pressing topics that truly matter to you and your business. Until next time, stay safe and take care, everyone. Thank you, Heena and Shruti.